watching another episode of Insightful Principles. In today's content, I want to talk about the difference between pre-tax, after-tax, and a Roth 401k. All three of these are very important to know because when it comes to investing your retirement accounts for the long term, you want to be able to identify what your potential tax liability is going to be throughout retirement. So within this video, I'm going to talk about which one should you consider, what are the pros and cons of each. I'm going to break it all down and really just highlight some of the things you should be paying attention to when it comes to contributing to your 401k plan. If you all could do me a huge favor, if you could please like, subscribe, and share this video. Don't forget to hit that notification bell below so you can be notified every week when I drop content. So just like with an IRA, which is an individual retirement account, you typically have the option of investing either in a traditional or a Roth IRA. Well, with a 401k, a lot of people don't realize that you have that same flexibility. Now, it is going to ultimately determine what your employer allows if they give you the option to contribute either after tax or Roth, because most 401k plans tend to be pre-tax as far as what the employer offers, but this is worth looking into to see if your employer gives you the option to invest in after tax or Roth contributions instead of the traditional just pre-tax options. And even for my business owners out there, entrepreneurs, if you're wanting to offer different 401k plans for your employees, it's very important the ways that an employee can contribute to a 401k plan. Now, when it comes to a pre-tax 401k plan, typically the way it's going to work simply is you don't pay your taxes up front. You have that deduction up front with your contributions, but then when you get into retirement, you are going to have that tax bill. Now, it is ultimately going to determine on your tax bracket, and it's going to be looked at as ordinary income when you decide to pull from your 401k plan throughout your retirement. So the 20% is kind of the minimum, but it could be higher or lower depending on your tax bracket. And of course, if you're over 59 and a half, you don't have that early withdrawal penalty. If you are under that age of 59 and a half, you do have that 10% early withdrawal penalty that is on top of that. Now, just to put this into context, let's say that you've accumulated over $1 million in your 401k plan. It was all pre-tax. When you get into retirement, you're going to have a $200,000 tax bill because of that 20%. So definitely pre-tax is really for those that, let's say they are already in a high tax bracket now and they don't see their income changing much, they don't see their earnings changing much, and they don't mind paying the taxes on their assets, on their pre-tax amounts. That usually will be for people that they've already are in that tax bracket that's much higher, so it's not going to be advantageous for them to move to Roth. So I definitely think that the pros of this option is, of course, you do get that deduction up front, but the con is you do have that bigger tax bill within your retirement. For Roth 401k, what happens with this option is you pay those taxes up front, so your contributions are made with after-tax dollars. And then when you get in retirement, you have tax-free withdrawals on both the earnings and also the contributions. So with the Roth 401k, of course, you are paying those tax deductions up front. So you are going to have the taxes that you're paying. But in the long term, as long as you've had the account for 5 years of your first Roth contribution, you're over 59 and a half, that's tax-free withdrawals on the earnings, the contributions, which can be tremendously helpful for those that they plan to be in a higher tax bracket when they get in retirement. So this option is great for those that you're in a lower tax bracket now, but you're expecting that your earnings are going to increase over time, and you see that you want to have most of your retirement assets and tax deferred accounts, then you will want to contribute into the Roth 401k, because when you get in retirement, you're not going to have any tax liability because none of your assets are pre-tax. The cons of the Roth 401k is it doesn't really help high earners. I kind of mentioned with the pre-tax Those are mainly for those that are already high earners, because with pre-tax, most of the time they're going to just take not having that deduction at the beginning, but at the end they'll go ahead and pay that tax bill. But when it comes to a Roth, if you're already a high earner, or let's say you're going to retire in 2 years, it doesn't really make sense for you to transfer to Roth, because your income hasn't changed much. You're not making more than what you already previously were making, and the majority of your assets are going to be taxed because there are in pre-tax accounts. Now, what I will say is, based on experiences and working with clients, diversifying between pre-tax and Roth could be beneficial for you from a tax strategy standpoint. If you're trying to look at, okay, I don't want to have as many of my pre-tax assets having to go to Uncle Sam or have to be paid in taxes. So you don't have to pick one or the other, but I think it's important to know the differences between the two and kind of deciding on, based on your financial circumstance, what's the best in your situation. It's also the after-tax 401k plan. Now, with after-tax, it's very similar to Roth. You're paying that tax bill up front, and at the end, you don't have taxes on the contributions. But the main difference between a Roth 401k and an after-tax 401k is, with a Roth 401k, you don't pay taxes on the earnings. With an after-tax, you do have to pay taxes on the earnings. So let's say you put, I'm just going to use small numbers for this example. Let's say you put $5,000 into an after-tax 401k and it goes up to $10,000. Well, that $5,000 of earnings is going to be taxed. Now, that $5,000 of the contributions that you put into the plan, that won't be taxed. So the after-tax 401k is for those that they want to pay the taxes up front now. They don't want to have as high as a tax bill as what they would have in the pre-tax account. It could definitely be a good option from that standpoint. But I think the biggest con with the after-tax 401k is that you're taxed twice. You're taxed on the front end with just your after-tax contributions, and then you're taxed on the back end with the earnings. I definitely think pre-tax or Roth is great options based on kind of like what I went over with your tax bracket and kind of what your financial goals are and what you plan to do with the money. But I definitely think all three of these options are very important when it comes to understanding how you can contribute into a 401k plan and getting a better understanding of what your tax liability will be within the retirement. So the contribution limits with any of these three options, you do have up to $20,500 that you can contribute into a 401k plan. And for those that are 50 years old and older, you do have the option of catch-up contributions of $6,500. So definitely is beneficial also from that standpoint of how much you can put into a plan. But that wraps it up for this video. I hope it was helpful for you all. Do me a huge favor. Please like, subscribe, and share this video. Don't forget to hit that notification bell below so you can be notified every week when I drop content. And I thank you all so much for watching, and take care.